Good afternoon, everyone. I'm David Gardells, and I'm a partner in Husch Blackwell's Renewable Energy Group. I focus my practice on renewable energy matters and represent primarily developers and owners of renewable energy projects, mostly ethanol and renewable natural gas, as well as the two kind of topics that we're going to talk about today. And we're very excited about this current environment where the emphasis on low carbon economy is getting a boost from this recent federal legislation, which we're going to talk about. So first, a few housekeeping items. At the bottom of your audience console, there are multiple application icons for your use during the program. If you have questions, please submit via the question box. We'll try to answer all questions during the webcast, but we might also answer by email later if we run out of time. A PDF of the presentation is available in the program materials folder that's there at the bottom of your screen. And importantly, for all the lawyers on board, the program's approved for legal education hours, and to report your hours, click on the CEU icon at the bottom of the screen. And a certificate of attendance, including course numbers, will be emailed to you tomorrow, along with the recording of the webcast that you can watch again later. And there's also a short survey, and we always appreciate your feedback on the content and format, technical issues, all of the above. So presenting with me today are my colleagues, Andrew Eastman and Tori Sitz. Andrew's an accomplished corporate attorney with extensive litigation experience, representing clients with a dual emphasis on commercial success and risk mitigation. Prior to Husch Blackwell, Andrew served as general counsel to a national developer of landfill natural gas projects. Tori is an accomplished transactional attorney and chairman of our firm's mergers and acquisitions subcommittee. She focuses her practice on securities, mergers, acquisitions, and joint ventures, corporate governance, compliance, capital markets transactions, and other matters within the energy and natural resources industry. Well, that's all for housekeeping. Let's get started. So we're really going to talk about two slightly different topics today. One, methane destruction, just real briefly, and then much of the program is going to focus on carbon capture and storage. So kind of as an overview and a common point here between the two topics, with the increasing focus on reducing CO2 emissions, industrial plants in numerous industries are under increasing pressure to reduce CO2 emissions. And in particular, ethanol and other biofuels companies are in a race to lower carbon intensity scores for the sale of their products into California and other regulated and voluntary carbon markets, and to take advantage of the new incentives. So again, we're going to start briefly with a description of a methane reduction project. But a core concept of everything that we're doing in the area of carbon reduction, and with this increasing buffet of benefits and incentives, is that each of these projects kind of creates a bucket of value that's in the products that are being sold, like ethanol has more value if it's low carbon, and there's tax benefits and these other specific benefits. And really, the parties to a transaction should view all of those things as one pool of economic benefits that can be allocated and shared among the project participants, and can be revised and fixed based on project structure and just the contractual allocation of risks and rewards. So I would say that the real complexity in negotiating these contracts comes around figuring out all of those things in each bucket and negotiating who gets the value. So again, just briefly to mention a particular kind of methane destruction project that's created under the California Air Resources Board. And it seems odd that you should get benefits for just flaring methane as it comes out of a use, but because methane is much more potent as a greenhouse gas, producing CO2 is actually a good thing. So again, CARB has created a registry and tracking program. So basically, this program allows someone who is a polluter or generator of CO2 to purchase a credit that's available and is on the tracking system. And then he can, get a benefit by purchasing a carbon offset credit from an entity that's approved, registered, and where there's something available for transfer within the account. And obviously, money changes hands along with the credit. So in a methane destruction project, there's a project company that constructs, maintains, and operates the methane destruction project to create CARB offset credits. And this program obviously is subject to many legal, technical, and ongoing compliance, reporting, and audit requirements. So like any regulatory regime, there's a lot of baggage that goes along with that. And the project company has a lot to do to reduce and hopefully eliminate the invalidation risk to the maximum extent possible. And there's also liability for non-compliance. So for example, if the equipment isn't maintained and stops functioning, the credits that you thought you were creating, wouldn't be available. So that's the key point there. So in the kind of contractual pieces of this kind of project are that the methane destruction entity, the project company, enters into real estate leases, easements, and other agreements with the mine owner. And these permit the project company to access existing methane vent wells, possibly drilling new vent wells, and allows modification of the vent well structure over time based on the productivity of methane production. And then the methane is destroyed or flared, which produces less harmful CO2 with equipment meeting the regulatory standards and subject to audit and verification. And then also an interesting feature in this industry is the ability for the project company to borrow against these offset credits. In fact, to do a structure that in finance we would call factoring, which is really the advanced sale of the carbon offset credits to an intermediary who is typically would be a company in the business of trading and making a market in all these different environmental benefits and credits. So structured as a sale transaction, but because you can do that up front, then part of the proceeds of that can go into the developing the project. And there's a lot of complexity around that, especially if the project company already has existing debt. But it's a pretty nifty program and based on the voluntary markets. So next, I want to set the stage for the following discussion on the contract forms and the Q45 credits, is to just talk a little bit about the carbon capture and storage projects around the Midwest. So thinking of the Ethanol Belt, and Andrew has a slide coming up in a bit. Iowa, Nebraska, the Dakotas, and other nearby states. There are multiple competing multi-project regional CO2 pipeline companies. So what I mean by multi-project is that these project companies are seeking to sign up multiple ethanol plants, connect them all to a kind of trunk pipeline. The trunk pipeline goes to a sequestration location. The sequestration big projects, one is heading towards Illinois, one is heading towards North Dakota, and still others are heading to Western states. And it all is dependent on the geology that is optimal for permanent sequestration of CO2. So these projects have a very high capital cost of constructing hundreds and in some cases more than 1,000 miles of pipeline. And the newspapers here are full of opposition from pipeline opponents, primarily landowners who don't want to see their cropland disrupted or bear any possible risk of leakage. So a second kind of CCS project is that a carbon capture storage company would contract with an individual CO2 emitter, like an ethanol plant, see if the geology at that location is favorable, and if so, just do a test well and then sequester the CO2 on site. And we traditionally have thought of the good sequestration places in areas where there's a lot of oil and gas, like western Nebraska, Oklahoma, Texas. But there's a surprising number of geology that is receptive to CO2 sequestration. And so I've been learning a lot more about geology than I have since high school. There's like the mid-Missouri upthrust or some such thing that comes all the way up this way from mid-Missouri. So anyway, in these projects, if the geology is good, the carbon capture storage company and the ethanol project enter into a suite of contracts for development, construction, and operation of the sequestration project. And again, the kind of key component there is allocating all the project attributes among the entities. And key in the ethanol context is the potential for a much improved carbon intensity score. And then in a single project concept, without the higher capital and transportation cost assessment for multi-project long pipeline projects. So we kind of covered that one already. And the project economics, the CO2 emitter, an ethanol plant, for example, would pay a transportation charge and other costs to get rid of the carbon, the CO2, get a lift in ethanol revenue for the ethanol or sustainable aviation fuel, as well as their other products. So we refer to this as, why would I pay to get rid of the CO2 I'm emitting? Well, it's taking out the trash, but also producing new value. And Andrew's going to get into the 45Q, but that particular significant incentive goes to the entity owning the sequestration equipment and related assets. These are the equipment that captures the CO2 at the emission source, compresses it, and gets it ready to go in the pipeline. And again, a lot of complexity around sharing the benefits and risks of that, as well as all the way to the end of the pipeline. And then we're always trying to keep our eye on what might be coming in the future, on other environmental and economic benefits that might accrue to the parties to the transaction. And it's not always possible to do more than say, we'll get together again if something better comes along, but we do try to provide in the contracts for discussion of that. So with that, I'm going to turn it over to Andrew, and he's going to ask some questions. We hope you'll all respond.
Thanks, David. Let me start by sort of taking the temperature on who's involved and interested in these projects. So if you'd let us know, is your organization considering pursuing a carbon capture project? And if so, how relevant to your decision will be newly expanded Section 45Q credits? So we'll take a minute and let people answer. We'll look at answers and then we'll jump in. We'll give it just a minute more. It looks like we've got about 25% of answers in so far. %50 of answers in. I'll give you a hint. If it's taking this long to answer, your answer is undecided. We'll give it just a minute more for stragglers and then see the responses. All right, of responses so far, about 41% NA, about 12% undecided, 30% very relevant. So for those who answered undecided, tell me more about the credits. Good, we will. And for those who answered very relevant, this might be a refresher for things you've looked into already, or hopefully we'll provide some additional information to help you firm up that decision. So to step back for a minute, what we're really talking about here in terms of legislative impact is a section of the tax code, the US tax code, called 45Q. 45Q is a particular section of the tax code designed to incentivize carbon capture, sequestration, which you might also call storage, and destruction, CCS being carbon capture and storage, or sequestration. And the way that the tax code does that through setting up these 45Q credits, which exist under Section 45Q, is that these credits are meant to be a performance-based tax credit. And the performance that they're based on is an entity's ability to capture and sequester or store the carbon emissions that come from a particular project. So to be able to generate these credits, to be an eligible project, you have to do one of two things. The first is that you've got to capture and then store carbon dioxide, CO2, in some sort of geologic formation. And that's the sort of formation David was talking about. And typically you see those in traditional oil and gas territories. Oil fields tend to be good geologic formations. If they held oil, they can likely hold gas once they're empty of oil, or saline formations. These things have got to meet a couple of geotechnical criteria, primary among those being a lack of permeability. When gas goes in, it's got to stay in. There needs to be less than X% ability for that gas to seep out and escape. Otherwise, there's not a whole lot of benefit to the sequestration. Or these projects have got to capture and reuse CO2. And so to reuse, you might use that CO2 as a feedstock to produce fuels or other chemicals, byproducts, things like concrete, in such a way that results in emissions reduction. So really the goal here, if you can't sequester or store the carbon, is to capture it and reuse it in a way that prevents it from becoming an emission and puts it towards some other beneficial use. One of the primary ones that's not on this slide is in the food and beverage industry. CO2 is a lot of what's used to carbonate things like soft drinks and beer. It happens also to be a lot of the waste gas that's put out by an operation like a brewery or like a soft drink manufacturing plant. And so to the extent that brewers, soft drink manufacturers, others who use carbonation can capture and reuse that CO2, they're able to keep it from becoming an emission. They're able to repurpose it toward a new beneficial use. And if they check some other boxes, they're able to generate some 45Q credits for their trouble. And that saves them as well the cost of sequestration, storage, and transportation through a pipeline. So what we really are going to focus on today is what exists now in this world in the wake of the Inflation Reduction Act, and what do these 45Q credits look like now, a couple weeks into the life of the IRA. And so what they look like now, having really been dramatically revised, is that they're broader and we've got more time to get them and they're richer. So by having more time to get them, I mean that under the prior regime, you had to take a project and it had to start construction before the end of 2025. Assuming it checked all other eligibility criteria, it had to start construction, had to break ground prior to the end of 2025. That deadline has been backed up significantly by 7 years to the end of 2032. These are big projects, they're complicated, they've got a lot of moving parts. They'll have a Gantt chart stretching out a couple of years. And given what we've seen in the last couple of years in terms of global supply chain disruptions, starting construction prior to 2025 really is or would have been a significant challenge for some of these projects. These are some long lead term items, a lot of permitting, a lot of land rights, groundwork to lay before you start doing anything that even resembles construction. Backing that up to 2032 is a lot more runway. The other way these credits have been changed is that they're going to apply to new types of projects. They're not just going to apply to industrial capture projects, which are those capturing carbon emissions from some sort of industrial plant or industrial activity. And typically in that case, the plant is co-located with or adjacent to that industrial plant. We now have the ability to earn and generate these credits through what are called direct air capture projects. Those are carbon capture projects that, as the name implies, take the carbon emissions directly out of the air. This is essentially the exhaust hood that might sit over your stove on a giant and very complicated scale. But the concept is the same. And so what these new credits do is incentivize both projects more than they had been, but they especially prioritize those direct air capture projects. And we'll talk about that in just a minute. So in terms of the facility capture projects, those capturing carbon emissions from an industrial facility, as opposed to directly out of the air, those are going to start now at a base credit of $17 per ton of sequestered carbon and $12 per ton of reused carbon. So there's a preference for sequestering versus reusing carbon, mainly because reusing carbon historically means using it for enhanced oil recovery activity. And so to try and move away from oil recovery and move toward a lesser carbon intensive economy, the Inflation Reduction Act is going to more greatly incentivize sequestration as opposed to reuse, especially reuse for enhanced oil recovery. Now, if that project meets a couple of criteria, one is a prevailing wage, and the other is offering an apprenticeship requirement for the first 12 years of operation, in addition to during construction, those credits increase significantly. The credit cost per ton for sequestered carbon increases from $17 to $85 a ton, and the $12 per ton for reused carbon increases to $60 per ton. So these are significant increases, and they make for much more rich returns and a much more favorable financing climate as well. So those apply with respect to industrial carbon capture projects. When we start talking instead about direct air capture projects, and those are the type that the Act incentivizes, then these things become richer still. We start with a $36 base credit for tons of sequestered carbon and a $26 base credit for tons of reused carbon. And then if you meet those particular criteria, paying a prevailing wage during construction and for the first 12 years of operation thereafter, and if you offer an apprenticeship program, those credits are going to increase to as much as $180 per ton for sequestered carbon and $130 per ton for reused carbon. These are things that we need some guidance on in terms of meeting prevailing wage and offering an apprenticeship program. That guidance is promised and forthcoming from the Departments of Labor. And that will impact contract drafting. But while waiting on that guidance, the best practice is that contract drafting is going to include, and Tori will touch on this during her slides, that we are going to meet these requirements as set forth under the Inflation Reduction Act of 2022, including guidance promulgated thereunder, including on and after the effective date of this agreement. So as David mentioned, we need to build in some leeway for the parties to work and talk together to capture these credits. Capturing them is going to be to everybody's benefit, but we need to draw language sort of tightly enough that we know what we're talking about and that we're obligated to work together to capture these credits, but broadly enough that working together can be informed by the guidance that we all expect out of the Department of Labor. So not coincidentally, because you got to pay prevailing wage for 12 years to get the bonus credit, you can claim credits for 12 years after a project is put in service. So in order to claim that credit, your facility, your project has got to hit a couple of metrics. If you're going to capture carbon from the air directly, you're building a direct carbon capture project, you've got to capture 1,000 metric tons annually. That's the lowest threshold. And again, that's put in place to incentivize direct air capture projects. The Act means for them to be the easiest to qualify and it means for the credits they generate to be the most rich credits. The least incentivized capture project is going to be capture from an electric generator. They've got to capture over 18,000 metric tons annually in order to qualify for a 45Q credit. And then in the middle there is any other facility at 12,500 metric tons annually. So those are the criteria. For a large project, hitting those is not going to be an issue. And again, these are all meant to incentivize these direct air capture projects and further to incentivize carbon sequestration over reuse, and thus to try and move the energy economy away from traditional oil, gas, carbon-based fuels. So when financing these projects through tax-exempt bonds, and a lot of them get financed that way, there is going to be a reduction in the amount of the credit. It's still going to be greater than what it was prior to the Inflation Reduction Act. And the Act further provides a little bit of flexibility in terms of putting projects in service and starting construction if those things are impacted by natural disasters. It's got to be a federally declared natural disaster, and the government is going to be somewhat tight in describing those things, but there is some flexibility. And as we see sort of more and greater unpredictable weather events, that's going to be important, especially as these projects get built in places that might be subject to some of those events. So generally, I think it's fair to say, by and large, the industry has been appreciative of this. That's because they've been doing this already to a large extent, and they're really eyeing these richer incentives. Some of them, Occidental, Exxon, Mobil, Chevron, have got projects underway already. I think the largest is being built in Mexico by Occidental Petroleum. They've been very supportive of these provisions in the new act, and they see carbon capture and sequestration essentially as a new revenue stream. This is not something that's being foisted on them. This is more like a new opportunity being made available to them. It's something they're doing already, and they see a tremendous upside to continuing to do it under the auspices of the Inflation Reduction Act. So the teeth in the act, other than incentivizing companies to do this sort of work, is that they're going to be penalized for not doing the work. And some of them, if they fail to cut or to capture emissions, are going to get fined, and in some cases substantially, up to $1,500 per metric ton of methane emitted. So the idea there is not only to incentivize capture, storage, and sequestration and reuse, but also to punish the failure to do those things. So part of what the Act has done to make this a more favorable prospect to companies is not only create these richer rewards, not only create this, add some teeth to the Act in the sense of fines for failure to cut emissions or to capture emissions, but there's a pot of money that's been created called the Greenhouse Gas Reduction Fund. What the reduction fund does is takes about $7 billion and appropriates that under the Clean Air Act of 1963 by inserting it into there and providing in that appropriation that this pot of money is going to be made available to the EPA for the next 2 years. And what the EPA does with this pot of $7 billion over the next 2 years is spend it down to zero by awarding it as grants, loans, incentives, financing options on a competitive basis. So you need to apply for these things. But that money is going to be given to states, tribal governments, municipalities, cities, townships, other recipients for the purpose of deploying either zero emission technology or carrying out what they broadly describe as being other greenhouse gas emission reduction activities. The $64,000 question is going to be whether a carbon capture and sequestration plant is going to pass muster as a quote unquote other greenhouse gas emission reduction activity. If so, and we're optimistic that that is the case, then that's going to be $7 billion of extra money on the table to get these plants built. And that is going to come, if not in the form of grants and low interest loans or awards, but if not that, in the form of other competitive bid-based financing options. And that hopefully is going to make this an even more attractive landscape for companies who are considering these projects, who are pursuing these projects, and who the Act wants to reward for putting these projects into service. So, as David mentioned, historically, we see most carbon capture and sequestration activity happening across what we call the Ethanol Belt. You'll see by the green there that most of these projects that are presently in service are tied to ethanol producing states, and they tend to be co-located next to ethanol production facilities. That's where the pipelines tend to be. That's where pipeline construction tends to be. Those plants support the pipelines support the plants, and that's where the activity is. You'll see sort of a smattering of that as well attached to natural gas processing plants. Those tend to be the sequestration and capture and storage projects that work with the carbon that's put off as a byproduct of natural gas upgrading. To a lesser extent, you'll see this around hydrogen and ammonia plants as well. But historically, this has been really tied to ethanol. That is probably going to be expanded to other industries under the Inflation Reduction Act. There's simply too much on the table for this to stay confined to one industry. But historically, this is how things look. Up until 2020, so not counting the last couple of years, we can see what the curve of these projects has looked like. This doesn't take us through 2020. I think that in the wake of the IRA, that 2022 and onward, this is going to look like a sharp, sharp, sharp hockey stick. This gradual curve that gets to be a little bit less than gradual and more dramatic in 2010 is going to start looking like a 90-degree arrow pointing upward in 2022. So it sounds like from responses to questions, that might be the way that about 25% of our respondents are leaning. And that might be something that sort of approaches the tipping point for some that were undecided. So I appreciate the time and the attention so far. And with that, we'll turn it over to Tori.
Thanks, Andrew. Good afternoon. Great to be here with everyone. And here we are now at our next poll question. And that question is, so if you respond accordingly, is asking essentially whether you or your organization is currently involved in a CCS project where you've already negotiated a carbon capture and sequestration agreement, whether you're in the process of negotiating one right now, or you're considering a project in the future which is going to involve the contract negotiations, or you're just not considering a CCS project at this time and you just wanted some information on CCS. So I'll give everybody a moment to respond, and then we will move on to the next section. Oh, we just passed 50%. Just give it a few more seconds and we'll go with what we've got at that point. All right, so let's go with what we've got now, which is, oh. So we've got 64% are not considering a CC project at this time, and about 21% are considering a CCS project, which might result in the negotiation of a contract. Some are currently, about 10% or 11% are currently in the process of negotiating a contract, and about 3.64% have already negotiated a contract. I've lost my video, but oops. Bear with me, I'm suddenly just only in the screen. There we go. So obviously with that lead in of a poll question, that is going to, that leads us right into, as no big surprise, the next topic of this discussion, of this presentation, which is some key contract considerations that parties should think about whenever they're about to negotiate a CCS contract. As David has already indicated, one of the fundamental issues associated with both CCS and methane destruction projects is the allocation of the potential carbon credits and other environmental attributes associated with those projects. And then the allocation essentially of those credits will essentially be a key driver of the negotiation of the rest of the contract provisions. So you must spend some time at the very beginning, making sure you've got a clear and broad definition of what's going to fall under carbon credits or, environmental attributes, however it's defined. You want to make sure it's as broad as possible. It should include all credits, rights, offsets, tax benefits, anything related to greenhouse gas emission rights or similar rights. And it should cover whether or not they're created from a governmental authority or whether or not they are, created from other persons or through third-party contracts. So, and you also want to make sure they are ones that are created currently in existence or whether they're created in the future. That way you've got the broadest scope of what comprises a carbon credit for purposes of the contract. And once you have it defined, then obviously you then need to allocate it between the parties. Who gets the benefit of those credits? This takes lots of different forms. We've seen all sorts of variations on how these are split. Sometimes it's one party owns everything. Sometimes it's split where one party owns everything but the 45Q, and that is as Andrew and David both mentioned, that's tied to who owns actually the capture, the carbon capture equipment. And there's also flexibility to do, especially when you've got these increased rates over the base rate that Andrew mentioned, going up to 85 or 180, depending on which type of facility you're developing. We've seen people do sharing of credits. So essentially one party will own it, and then once it hits a certain threshold, there's an economic sharing for any credits received above that level. So once you've got them allocated, one of the key things up front that you have to consider is kind of what are the impacts of defaults and and then potential termination of the agreement on those credits, and who's going to bear the risk of those. I'm going to talk about that in a little bit more detail in one of our subsequent slides, but as part of the very beginning of kind of exploring CCS projects, most suppliers, and refer to suppliers as the individual who's looking to, is either has an existing production facility or is going to be the one that's providing the CO2 that's captured and needs to be sequestered. They've done substantial financial modeling. They're looked at, what are the different values for the credits? What are the different levels of different credits at different carbon intensity scores? And sometimes they've actually pre-sold product based on the assumption that they're going to have a CI score of a certain, at a certain level, or they've pre-sold credits. So all of that goes into financial modeling at the front. And so understanding kind of what happens in these scenarios, if something happens, if there's a default, or if the off-taker can't take your CO2, that's going to be very important. And then you're going to run through all that through the financial modeling to see when do you not cash flow, when do you have potential liability to third parties. This is relatively, it's a somewhat kind of new field. There's still technologies being developed. Obviously, this is going to continue to grow and expand, especially in light of the Inflation Reduction Act. But essentially, the one thing you'll realize is that no party right now is really, you can sign a contract, but no party really, the day after signing is really in a position, typically, in most instances, is going to be in a position to perform. They're not going to be ready to have the carbon captured, and the off-taker is not going to be in a position to capture it and transport it to the storage site. There are significant critical conditions precedent that have to happen before a party is going to be ready to perform and either provide or off-take the CO2. And that includes the construction of the capture facility and the construction of the disposal facility. And those are going to be capital intensive. If it's an existing production facility, it's going to be co-located next to that plant. There's going to be, you're going to need to, whether you're financing it or it's being financed through the CCS provider, there's time required to construct that capture facility. Same thing on the other side with the off-taker. They've got to construct and figure out their disposal facility. Where are they putting it? Is it in an oil and gas reservoir? Is it going to be going down to a coal bed seam, the seams of old coal beds? Is it going into a salt mine? They're working on, and they're doing that obviously not for one individual supplier. They're doing that obviously for a whole host of customers who they're going to be off taking their CO2. Also, and these are the next three I'm talking about are, David alluded to, these are the really critical ones that have the most impact on timing or potential issues in connection with CCS projects where you're having it transported and you're not doing a kind of on-site CCS sequestration near your particular facility because the geology supports that. But where's the off-taker on the construction of the transportation infrastructure? They've obviously got to get a pipeline that goes through multiple states to get to the storage facility and the disposal site, and they also have to build a pipeline that goes direct from the individual supplier facility and goes to their main pipeline. You've obviously got government approvals. You've got landowners who have to grant you rights to the easements, give you access to their property. All of those are significant, significant impediments and conditions precedent to being able to actually make the entire CCS project operational. Obviously, there's been lots of public outcry, and you've got people resisting. So those are significant timing hurdles that need to be addressed. Sometimes you can also have we've been talking a lot about facilities that are kind of located next to an existing facility. But you could also have a greenfield project, which is deciding to build a carbon capture sequestration portion, right along with that. That obviously creates a bigger timing impediment because you've got to construct not only the production, not only the carbon capture facility, but also the production facility. And then financing. Do the parties have the funds to finance the construction? Bigger issue mostly, on the supplier side, especially if you're doing a greenfield project. Do you have the financing lined up in order to fund the full construction, get a construction loan? If you've got access to public markets, do you have a comfort that you're going to be able to raise the equity that you need to finance that portion of the project? All of these are going to be key conditions precedent that are going to play into when does your facility actually become operational, and because it's going to tie into some of the termination and some of the liability and risk exposure, I strongly recommend both the business and the legal team should have very upfront early conversations about these issues and figure out where exactly is the off-taker with respect to the disposal site. What are they looking at? Where is it located? Where are they? How much pipeline do they have access to that's already constructed? What do they have to construct? Where are they with respect to government approvals? Have they submitted any permitting? Where are they with land rights? All that's going to help kind of guide the supplier to figure out who makes the most sense and which one creates the least risk. But it's having those conversations up front is we strongly recommend so everybody can be on board. And the off-taker obviously is also going to say be looking to where's your financing coming, and especially if you're doing a greenfield project where you're doing the production facility at the same time as the CCS. So as I mentioned, all of this kind of leads to the next discussion, which is the term and termination provisions in the contract. These are long-term contracts. They typically run to be between 10, 12, 15 years. So this is a long-term partnership that you're going to have with the CCS off-taker. And as I mentioned, nobody's going to be ready to perform immediately after your contract signing. So you're going to have an effective date of the contract, but then the actual start date when the facility is actually operational is going to happen later. It's going to be a commencement date, a start date. That could be it could be an anticipated one. It could be guaranteed. But that's when each party is going to have basically satisfied all of its conditions precedent, and they're going to be in a position to, as a supplier, to capture and have all the CO2 that they're going to deliver ready to deliver to the off-taker, and the off-taker is going to be in a position to grab that CO2, transport it, and sequester it in their disposal site. So that's going to be a separate date. Looking at that date and setting that date is going to be another reason why having those conversations up front with respect to where everybody is in connection with the conditions precedents is very important, because you want to set a realistic date. You want to make sure that you're not setting a date that's unrealistic, especially if you start building in potential liquidated damages or other kind of provisions in the contract that that come into play in the event you fail to miss that date, or if you miss that date. You also will see a lot of times some incorporation of drop dead or long stop dates. So you've got a start date. So what, but you missed that. Going to continue to construct and continue to work to moving towards, getting an operational facility. And this applies on both sides, both from the supplier and the off-taker, because you're looking at two separate facilities being constructed. But at what point does a party have the right to pull the plug? I mean, from a supplier, if you're ready to go, you've hit your start date, you have CO2 ready to go, and you've got an off-taker that's sitting there, that's still working on getting pipeline governmental approvals for the pipeline. They don't have their storage site constructed. At some point, you need to be able to pull the plug and say, I got to find somebody else to take this. Because again, going back to that financial modeling, you may have been building in the value of the credits that you're going to get if you're getting the credits, the lower CI score that you're getting, and so you're getting products being sold at a higher level. You could have financial obligations to third parties if you sold the credits, and you could have pre-sold product at a higher rate based on an assumed CI score. So you got a higher, so you might have third-party obligations. So you need to consider at what point do you pull the plug there, and when we touch on like liability issues, the time period between the start date and the long stop date is, who's responding, what are the damage and what are the risks that are happening between there, and who's liable for all that lost value that may occur. Okay, so now assuming you've met all your conditions precedent and both parties are operational, there's obviously going to be performance obligations under the contract. Each party is going to, the level of focus and detail you put onto these is going to be very contract specific. And it's also going to be impacted by who owns the credits. As I said, the allocation of the credits is going to drive a lot of the negotiations and see who's pushing on which point more so. So one of the key things is obviously the fundamental purpose of this is to have one party supply CO2 and the other party take it. As a good capitalist, most CO2 off-takers, they want 100% of the facility's CO2. Usually not an issue because the supplier wants to have as much CO2 taken so they get the benefit of a lower CI score and maybe potentially become a net zero facility. And the value of any either higher product sales or other higher credits that they may be able to obtain with a lower CI score. However, one thing on the supplier side, you need to take into consideration before you commit to any type of minimum supply volume is whether or not you already have some contractual obligations. For instance, in the ethanol business, a lot of the plants will already have existing contracts with a third party where they're providing a small portion of their CO2 to a third party that makes dry ice. So you need to make sure that's either carved out, or you can look at the expiration dates or renewal dates for those contracts and then figure out how it plays into your start date and either let it not renew, but just to make sure you don't put yourself in a position where you're going to breach one of the contracts. And in the realm of what's good for the goose is good for the gander, most of these come over with just a minimum supply volume. We always like to have a minimum offtake volume. So we want to have the offtaker committing to take a certain amount of our CO2. And you set up the minimum volume there, because obviously we again going back to financial modeling and the impact of this, the carbon credits and any of the lower CI scores that we've gotten as a result of the CCS project being attached to our facility. You've kind of baked in that you're going to get these, and you've got to keep you want to make sure they're taking enough that you're going to get those credits. CO2 specifications. This is one, obviously, this off-taker is going to need, they're going to want the CO2 to meet certain specifications in order to ensure, it's of a quality that's safe for transport in the pipeline. If there's impurities in there, that can create leaks and other explosions. So your internal team will look at that and make sure the CO2 specifications are acceptable. The contract will also obviously address, the off-taker is not going to be required to take CO2 that does not meet these specifications, and they'll have the ability to reject non-conforming CO2. And that non-conforming CO2 obviously will not count against the minimum supply volumes that may be baked into the agreement. Similar on the flip side, if if you've got a CO2 supplier who, you've got CO2 that meets the specifications, but for some reason the off-taker can't take it because for whatever reason they've got an issue with their pipeline, an issue with the storage site, they're at capacity, whatever the reason, you want to make sure those provisions that are dealing with the delivery and supply, if you're a supplier and you've provided conforming gas and they can't accept delivery, and they vent it or flare it, that is still considered part of your minimum supply. And then obviously it doesn't count against their offtake minimum. So to the extent there's any shortfall damages, those concepts are taken into consideration. These next 4 bullets, this kind of comes to the crux of some of the meat of, again, this is tied to the allocations, and that's ensuring that the CCS facility and the sequestration site are operated as a qualified facility. And qualified facility, as Andrew mentioned, is a term under the 45Q regime, requires construction construction start date by a certain time, and requires a minimum metric tonnage that's being off-taken by the emitter. But there's other requirements throughout 45Q. So you need to make sure you're comfortable with the off-taker is going to be able to satisfy all those, and that they've got a specific rep warranty or covenant that they're going to construct, operate, and maintain the facility in a way to satisfy that qualified facility definition. You also need to consider that type of specificity. I mean, at least referencing other critical carbon credit regimes, and most notably the LCFS. Most of these biofuels companies and other companies are trying to sell into the California market to get the benefit of the LCFS, the low carbon fuel standard, the credits associated with that program. And not unexpectedly, there are a significant amount of requirements under that CARB has put in place, the California Air Resources Board, associated with getting LCFS value, credits and higher values for carbon capture and sequestration facilities. They actually have a protocol. It's called the Accounting and Permanence Protocol for Carbon Capture and Geologic Sequestration under LCFS. It's 133 pages, and it's got all sorts of reporting requirements, compliance requirements, testing, auditing, verification. So you're going to want to make sure that the party, whoever responsible for the construction, operation, and maintenance of the facility, is going to comply with those. I'm not saying you should attach to your contract a 133-page protocol, but you at least should reference it and say they're going to continue to comply with all the requirements under there, that they're going to assist. Either they're going to get or they're going to assist the supplier, depending on who is getting it, in getting a permanence certification, which is issued by CARB, and that's basically how you basically confirm that your carbon is being permanently sequestered and you get access to these higher value credits. And that somewhere in there, you've got obligations of the parties to provide data, information, access in order to give, to get the information that you need to report to the respect, to CARB and to any other government authorities where you've got these reporting obligations, auditing, obligations in order to get the credits. So that should be covered to some extent. But like I said, it doesn't have to be in extreme detail, but you need to make sure the parties are comfortable, they understand what their obligations are with respect to that. The one caveat I would say on level of detail is, something that Andrew mentioned, and it's tied to the 45Q. Just because, he mentioned, obviously, we've got, in order to get a credit that's above the base rate, which can be significant, $85 for CCS on, for regular industrial facilities, and then much higher, obviously, for up to 180 under direct air capture. Those the prevailing wage and the apprenticeship programs, you're probably going to want to build in something pretty specific, at least a specific reference and obligation of the parties to comply with those as they exist now, or as they're modified with respect to any guidance, as Andrew mentioned, that the Department of Labor is going to issue. And that's important because you need to make sure that it's not only the off-taker, but every single contractor and subcontractor throughout the chain is also going to comply with that. So you want to make sure your contractor's agreeing to do that, and they're agreeing to only hire contractors and subcontractors that are going to be able, that are going to be complying with them as well. So, because I think the way I understand it is, if one of them blows it, and this will come out and be clarified in the guidance, but if one of them blows it, you then have not satisfied the prevailing wage. Okay, next I'm going to liability issues. Obviously, every contract is an allocation of risk. And, the risk associated with CCS projects is really kind of what happens. First, if there's a default on the volume requirements and there's a shortfall, and then what happens if a company doesn't hit their start date. You can have all sorts of volume damages provisions, and you got to, they can complicated formulas as to whether or not it's as simple if you've just got somebody who's doing, an off-taker who's just getting a per metric ton rate, and the supplier doesn't hit the minimum volume. That's an easy, calculation. But if there's allocation of credits between the two, you got to figure out, how do you capture and how do you account for those damages where you've got credits that you've lost, you've got credits that are recaptured, you've got credits that you don't get, that you now have third-party liability, and you'll have long long provisions and long complicated formulas kind of dealing with that. But so you need to expect to spend some time on that and really figure out who's going to bear that risk. And you may not get fully, you may not ever get, fully compensated, or you may, it just depends on the negotiating leverage, but it's something that needs to be considered. Indemnification, obviously you're going to have standard indemnification provisions in almost every contract. Same thing here with indemnification. It's going to be whether or not the off-taker is going to be, or, could be go the other way, depending on who owns the credit. Is one of them going to be willing to stand behind the process and say, okay, yeah, we, because of our gross negligence, you lost the credits and now you have liability to this third party. We're going to indemnify you. Again, just a key negotiating point for indemnification. And then insurance, it's a new area. I'm not sure if there's any really insurance providers that are really out there covering kind of, carbon credit loss. But if there are, it's good to get those contractually commit, this off-taker to contractually commit to do those, to continue to monitor that. And I think we're about out of time. This last one, so I'm going to skip over this last provision.
So let's just skip over that last slide, which you've got another list. And again, the slides are available to everybody, at the bottom. So there are two questions that we have so far. And one is, are there any environmental risks with carbon capture and storage? And so certainly the pipeline opponents think there is. I mean, obviously CO2 is something we're all breathing in and out right now, but in a highly concentrated form, it does have some risk. And apparently there is one documented case of a high pressure CO2 pipeline that burst, and the CO2 pooled in a low area, and it was lethal perhaps to some livestock. So that one is always stated, but obviously with all the safety considerations and permitting, whatever, there are just extreme measures being taken to be sure the pipelines are operated, in a safe way and monitored way, that if there's any breach, that it's dealt with promptly. And then another question we have asks about comments from us on possible credits for atmospheric direct air capture combined with green hydrogen to produce synthetic fuels for carbon reduction by replacing methane. And, certainly what we're seeing in our contracting practice is not only, a lot of attention to all the different credits, who can take them, what are the maximum incentives that you can get out of a project, but also into potential new uses. And in particular, the use of, the greener hydrogen that would come from projects that stack all of these processes together. So we certainly are seeing people, constructing these things based on adding wind and solar and carbon capture and all kinds of process things to reduce the energy consumption and the carbon intensity, and to produce a product that can then go into green hydrogen production. So we're going to see a lot more of that, and there's lots and lots of new technology that we're reading about every day that are finding new ways to, use things like the CO2 for more beneficial uses. So with that, that brings us to the top of the hour, and we just want to be respectful of your time. And Tori, you have some concluding slides.
Yep, actually, we just have a housekeeping item as we go. Again, thank you again for everybody for joining us today. We appreciate your time. I know everybody has busy schedules. Hopefully it was helpful and informative. As a reminder, the program has been approved for legal education hours, and to report your hours, you just need to click on the CEU icon at the bottom of the screen. You'll get a certificate of attendance, including the course numbers, emailed to you tomorrow, along with the recording. There's a short survey that we ask everybody to take, because we love to hear feedback, and it helps us plan future programs that may be applicable to your business needs. And then for those that are more, have more appetite for 45Q discussion in the Inflation Reduction Act, Husch Blackwell did start a 3-part webinar series on the Inflation Reduction Act. 2 parts have already occurred. However, the 3rd part is occurring September 28th at noon Central Time. And then the prior 2 webinar sessions are available through links on our website, or you can obviously always email any one of us and we can get you connected with the materials. But it's a good review of all the new provisions in the Inflation Reduction Act and all the opportunities there are for parties to take advantage of those new regulations. So again, that concludes our webinar, and thank you everyone for your time.